Hello again. We will soon start some real serious work, but first we will begin with explaining some cost terms that will be useful throughout this course. Remember, managers need to close attention to cost because a dollar in cost reduction is a dollar more in company's income. Just going through concepts can be a bit boring, but it is important to know the language because it is the foundation on which a solid, profitable business can be made. First of all, what is cost? Cost is something you pay or sacrifice to get something. A cost object is anything for which you want to measure cost. A simple way to understand cost object is to ask cost of what? Whatever is the answer to this question is the cost object. It can be a product, for example, cost of a pizza, or a department, for example, cost of running a cafeteria. It can also be cost of college education or even cost of a single class in college. Cost accumulation is collection of all types of cost for any cost object. For example, cost of making a pizza might include several types of raw materials plus labor plus rent of the store, cost of utilities, repairs, insurance, depreciation, etc. Putting together all these costs is cost accumulation for a specific cost object, in our case, pizza. A cost pool is like a box or a bin in which all indirect costs are pulled together to be assigned later to a cost object. We will shortly learn about direct and indirect costs. A cost driver is anything that affects total cost over a given time period. Simply speaking, a cost driver is something that drives the cost up or down. For example, the number of pizzas made in a store will drive what the total cost of raw materials will be. Cost allocation is a step after cost accumulation in a cost pool. It is the process by which costs are allocated to different products or departments. We will discuss this in more detail when the time comes. Relevant range is the range of normal activity in which cost behaves, in a manner of speaking, in a nice way. For example, I can say that the room in which I teach my accounting class has a fixed monthly rent. This means that I pay a rent of $2,000 a month whether I teach one student or 50 students in the room. But if I have a room with a capacity of 50 students maximum, then 0 to 50 is the relevant range for the rent. If I have 53 students instead, I will need a second room suddenly, doubling the cost of renting. So, rent is fixed only within the relevant range, not outside it. Let's pause briefly and review. Remember, a cost object is anything for which cost can be measured. We can measure costs of products, costs of servicing customers, costs of running departments. So, all of these answers are correct. So, our answer is D. Let's look at this one is about how a cost system works. The question is, a cost system determines the cost of a cost object by how does it determine the cost? Option A says it collects and then assigns cost. Sounds right. Option B says it just accumulates cost. But unless the accumulated costs are assigned to a cost object, it won't be helpful. So B is not the right answer. Option C says assign first and accumulate later. That is incorrect. Unless you collect different costs together first, you cannot assign them. Last one assigns without accumulating. Wrong again. So our answer is A. Direct cost of a cost object is are those costs that can be traced to it in a cost effective way. Direct cost always pertains to a cost object. What is that? Direct cost of what? That is our cost object. Let us suppose you want to know the direct cost of making a cheese pizza. Now, cheese pizza is your cost object. Now, look at any cost. Flour, cheese, sauce can directly be traced to pizza. In simple words, if a material is going into the pizza, it is a direct cost. If some labor is used in making the pizza, it is a direct cost. Sometimes direct labor is also called touch labor. That is, if it touched it while making the product, it is direct labor. It's even easier to understand direct costs once you know what costs are not direct, that is, what costs are indirect. If a cost is related to the cost object but cannot be traced in a cost effective way, it is an indirect cost. For example, how much salt is used in making one pizza? There's no really easy way of knowing that. So, although salt was bought to use in pizza, it is not direct material cost, but it is indirect material cost. Similarly, if you bought light bulbs to change in the kitchen, it is material, but it is not going into the pizza, hopefully. So, it is not direct cost. So, the first check if a cost is direct or not is whether it is a material. Then, the second check is if it is direct material or indirect material. Let us take another example of indirect labor cost. A janitor who comes to clean the pizza store is labor, but not direct labor because he's not making the pizza, just helping the store run smoothly. Let us review quickly. The question is about how you would decide if a cost is direct or indirect. Remember, we said that if a cost can be easily identified or traced to the cost object, it is direct. Otherwise, it is indirect. So, C is our. This question is asking us to pick the best example of direct labor cost. Remember, direct labor is labor cost that is touch labor, meaning it must have helped in actual production of the product. If you go down the options, you will see that option B is the only type of labor that actually is involved in the production. All others, maintenance workers, managers, supervisors, guys who are taking care of raw material storage, are not producing anything themselves. They just support the production, not actually do the production. So, B is direct labor, all others are indirect. Let us continue our discussion of costs. It is important for managers to understand the behavior of costs so that they can predict costs. For example, if I want to double the number of pizzas I make in my pizza store, I would like to know if my cost would double, more than double, or less than double. There are two basic ways in which costs behave. Some costs are variable, meaning that they change in proportion to changes in activity level. For example, if we double the number of pizzas made, we will have to double the direct material such as flour, cheese, sauce, etc. There is an important distinction between total variable costs and per unit variable costs. When we double the production, total variable cost would double. However, per unit variable cost would remain the same. This means that the cost per pound for cheese remains the same, but the total amount spent on cheese would double naturally. Fixed costs do not change with changes in the activity level. For example, if we double the number of pizzas made, the rent paid for the store would still remain the same. If we spread the total cost of rent over a larger number of pizzas made, per unit fixed cost would go down. Are you with me? No costs, however, are permanently fixed or variable. Some costs that are fixed for a year can become variable over a period of 5 years. For example, you might be committed yearly to an advertisement budget, but it can change after a year. Let's look at total and unit variable costs one more time to be absolutely clear. Suppose we have $1 worth of cheese to make one pizza. So, if we make one pizza, dollar cost of cheese would be $1. If we make 10 pizzas, dollar cost of cheese would be $10. For 100 pizzas, it would be $100 and so on. However, each pizza still uses the same constant, $1 worth of cheese. So, total variable cost increases and unit variable cost remains the same. Look at fixed costs too. My total monthly rent for pizza store is $2,000 a month, whether I make 0 pizzas or 10 pizzas or 100 pizzas. However, the more pizzas I make, the more I spread my $2,000 cost. So, if I make 100 pizzas, my per pizza rent would be 2,000 divided by 100, that would be $20 a pizza. If I make 1,000 pizzas a month, my unit cost will only be 1,000 divided by 2,000, divided by 1,000 pizzas, that would be only 2. Let's check if you are with me so far. If you go down the options on variable cost, you will notice that option B seems to fit the best. That is, variable cost increases in total when the actual level of activity increases. All other options, let us see. Option A is incorrect. We have not used direct or indirect in defining variable cost at all. Option C is clearly out of the question because depreciation is not a variable cost, it is a fixed cost. Option D is defining direct cost. So let us stick to answer B. Here, we have to pick the best variable cost option for an insurance company. Rent, salary, and property taxes do not go up when you make one more unit, but sales commissions do go up when you sell one more unit. So, option C is the only variable cost we are looking for. Okay? Let us see if you can pick what fits fixed cost best out of the 4 options given. Option A is correct because we say nothing about direct or indirect costs when we define fixed cost. Option B is a definition of variable cost, so it is wrong. Option C mentions material, which we know is a variable cost. Option D goes against the grain of fixed cost. Remember, fixed costs do not vary with production volume and cannot be adjusted in the short run. So let us stick with A as the best. Once again, we have the best example of fixed cost in a car company. Look for something that does not change with number of cars made. Only administrative salaries would not go up when you increase the number of cars made. All others will. So A is fixed cost, B, C, and D are not. Now, let's look at per unit cost and total cost. Unit costs are calculated by dividing total cost by the number of units produced. Total cost of making a product is the total of all costs incurred in making the product. Fixed costs, when expressed on a per unit basis, can be misleading. For example, if the monthly rent of the pizza store is $2,000 and you make 2,000 pizzas in a month, fixed cost is $1 per pizza. But if you double the production to 4,000 pizzas, total rent remains at $2,000 a month, but per unit fixed cost will fall to 50 cents per pizza. That is, $2,000 of rent would be divided by 4,000 pizzas made. There is an important lesson here. Try to work with total cost as much as possible. Another lesson is to divide total fixed cost by number of units made each time production level changes. In our example, if we calculate $1 per pizza to be the fixed cost, as we just did, it would be misleading to use the same number when production level changes to 10,000 pizzas because now per unit fixed cost is not $1. It has gone down to 50 cents. Since unit costs are calculated by dividing total cost by total number of units produced, it is also called average cost. This one is a little hard, so let's look at it very carefully. The question says that the company's relevant range is 50,000 units, meaning that their fixed cost will remain unchanged until that limit. If they move from 40,000 to 45,000 units, their per unit fixed cost will go down. This means any option where per unit cost remains the same can be safely thrown out. So option A and C are gone. Both B and D say that per unit cost will decrease, but B says that total manufacturing cost will go up and D says that it will stay the same. What makes more sense to you? If you make 5,000 units more, your total cost should go up, shouldn't it? So B is your right answer. meaning the total manufacturing cost will increase and unit manufacturing cost will decrease. Are you doing okay? If you get this last one, you are very, very fine. Here, you are given per unit numbers for both variable and fixed costs. It is obvious that the first three, direct material, direct labor, and variable manufacturing overheads, are variable costs, meaning that they will move proportionately with volume of production. The last one is a fixed cost, but per unit. Remember what we said, that it is important to work with total fixed cost whenever units of production change. So let's convert it into a total fixed cost number and work with it. Per unit fixed cost here is $10 and the company is making 1,000 tires. So total fixed cost should be 1,000 times 10 equal to $10,000, and it will not change until the company reaches the top of its relevant range, which is 3,000 units. So at 2,000 tires, the total cost of production should be a total of variable cost, which is direct material at $20, direct labor at $3, and variable manufacturing overheads at $6. Okay, all this times the number of units made, that is 2,000 units. This would be added to the total fixed cost, which we just figured out is $10,000. So the total cost will be the sum of total variable cost and total fixed cost at $68,000. Before we move further into problem solving, it is helpful to understand the type of company we are dealing with. Mainly, there are three types of companies. First is manufacturing companies, which purchase raw material, hire labor, and convert them into finished goods. Our pizza store is an example of a manufacturing company. A company making cars or tables or cell phones is also a manufacturing company. Merchandising companies purchase ready-made products and sell them without changing their basic form. Merchandising companies purchase ready-made products and sell them without changing their basic form. These companies are also known as retailers. Barnes& Noble, Macy's, and Target are all examples of merchandising companies, also known as retailers. Service sector companies do not provide a product, they provide a service instead. Yahoo, Google, Facebook, all types of banks, restaurants are all examples of a. Let's look at the cost of a manufacturing company more closely. Manufacturing cost of a company are all the costs that are incurred in making a product. So, right from the time the raw material comes into the factory to the time when it is ready as a finished product, all costs accumulated are manufacturing costs of that product. Manufacturing costs are usually grouped into direct material, direct labor, and manufacturing overhead. Let's remember, materials can be direct or indirect. Direct materials are those that can be traced easily to the product. Indirect materials cannot be identified easily, so we will keep direct material and throw indirect material out for now. Next, labor can also be direct or indirect. Keep direct labor and for now we'll throw indirect labor out. Now, pool together all other manufacturing costs which are neither direct material nor direct labor. Please remember that they must be manufacturing costs, not shipping or marketing or administrative or any other cost that is incurred after the product was made. So, we will use the third category of manufacturing overhead to throw in all costs that were spent to make or manufacture the good but could not make it in direct material or direct labor category. So, we will have all indirect materials in this bin, all indirect labors in there too, as well as all other factory related expenses like rent, taxes, insurance, and depreciation, etc. I will repeat it because it is important. If a janitor is cleaning the factory, it is a manufacturing cost of the indirect nature. If he is paid per hour, his wages are variable cost. If he is paid a salary per month, then his salary is a fixed cost. But if he is cleaning the CEO's office, for example, his wages or salary are not manufacturing costs because it has nothing to do with making the product. So, a cost can be direct and variable and manufacturing at the same time, depending on what we are measuring. So basically, don't worry about the different names and types of costs you are seeing. A cost number can wear several different hats in different contexts, and you will soon get comfortable with the name. As I said before, if a cost is not incurred in making the product but elsewhere in business, it is a non manufacturing or non inventoriable or non product cost, meaning period cost. So, all selling, administrative, and other office type expenses are non manufacturing costs. So, product costs follow the product, meaning if the product is sold out, the costs go out too. But if the product is not yet sold and stays in the company, then product costs stay too in the form of ending inventory. Period costs follow the period in which they are spent, regardless of whether the good is made or sold or not. So, if you spend $1 million on advertisement but sell, say, nothing, you will have to charge the whole $1 million of advertisement expense for the year to your income statement. Why? Because advertisement expense is a period cost and it follows the period in which it is incurred. On the other hand, suppose you buy $1 million worth of raw material but make nothing out of it and just keep it in the storage. You will have to charge nothing as an expense. You can show a raw material inventory of $1 million in your balance sheet as your asset. Why? Because raw material cost is a product cost and will be charged as an expense only when the product gets sold and goes out of the company. So all period costs will make it to the income statement in the period in which they were incurred, but all product costs will be divided into expenses and assets depending on how much of the product cost in the period. Why do we need to understand the difference between different types of costs and different type of companies? Because the accounting systems are slightly different for different types of companies. Accounting system of manufacturing companies is more complex than other type of companies. The main reason for this difference is the inventories used by a manufacturing company. They typically have three types of inventory. The first is direct material inventory. Since manufacturing companies buy raw materials and convert them into finished product, they may have some raw material left over at the end of the period for which the accounts are being made. For example, if you make pizzas, there is a big chance that on 31st December, when you're ready to close your books, you may have some flour and some cheese left. Work in process inventory has products that are partially worked on but are not yet completed. Pizza is not a very good example for this situation. Suppose instead you make cars. If a car is on the factory floor but is not yet fully done, it would be called work in process inventory. Remember, work in process inventory is like a black box for a manufacturing company. You put material, labor, and other manufacturing costs into the black box, and the final good, like a car, comes out. If the car is only 80% complete, it is neither raw material nor finished good, but something in between. We will learn how to calculate work in process inventory costs very soon. Finished goods inventory are goods that are ready to be sold but have not sold yet. Again, since there is no guarantee that the company will sell everything on hand by 31st December, there is a big chance that a manufacturing company will have finished goods. Now, please give me your full attention for a few minutes and you will be done with probably the toughest part of managerial accounting. We will see how costs flow through a sequence of accounts before they make it to the income statement. What we have here is a series of T accounts used to accumulate manufacturing costs. We begin with a raw material account. Suppose when we started the year, we had a beginning inventory of say 100,000. We purchased more raw material during the year. Now we should have a total raw material worth beginning inventory plus purchases available for use. Does that make sense? Now suppose we take out some raw material to use in production. So out of the total available raw material. If we use some, what should we left? Should we be left with? Naturally, whatever we are left with would be called our ending inventory. And since I paid money for my inventory and I own it, I can show it as my asset in my balance sheet. Are you with me so far? Next, we take the raw material out of materials account and transfer it to our black box, which we call work in process account. Remember, this is an account where we throw in all the ingredients of manufacturing cost and eventually the ready-made product will come out. So we throw in raw material, labor, and all other manufacturing costs and wait for the finished goods to come out. However, it's quite possible that all the production process is not complete by December 31st, which is your accounting year closing date. So whatever is complete will come out of the account, and the rest, that is the partially complete stuff, will stay in the account as ending inventory. So obviously, if our math is all right, we should be able to move from this account to the finished goods account. This account is like a warehouse where goods will wait until they are sold. If we have a beginning inventory in this account already waiting in there and we put in some more goods that we have manufactured, we should have a total worth of goods available for sale. If we sell them, they would move out of the account, and if they do not get sold, they would just stay there in our inventory. So the numbers that move out of this account would be cost of goods sold, something that you finally see in an income statement in financial accounting. Notice in each account there is a beginning inventory and an ending inventory. In each account, something comes in and something goes out. We can turn this into a simple equation and see if it helps us in making the situation clearer. So everything that we saw on the previous slide in the form of T accounts can also be shown in the form of equations. Please look at the basic equation very carefully. For each type of inventory, we can use the following equation to find out the ending balance of inventory, because beginning balance in each type of inventory account plus what gets added to that inventory would always be equal to the credit side of that account, which would have two items there: the ending balance of that inventory plus whatever gets withdrawn out of each inventory. For example, in materials account, we have beginning inventory plus new raw material that we purchase on the debit side, which must be equal to ending inventory plus what gets used during the period. Does that make sense? Similarly, in work in process account, we would have beginning inventory plus all manufacturing costs that we add during the period. Remember, manufacturing costs include three things: material, labor, and manufacturing overheads. This total must equal what gets thrown out of this account as completed goods plus what is left as ending inventory. Finally, the same logic can be used for finished goods inventory account. The debit side will have beginning inventory and what gets manufactured, that is cost of goods manufactured during the period, which has to be equal to what gets sold and thrown out of the account as cost of goods sold plus what is left as ending inventory waiting to be sold. So, if you understand the basic equation, you can see that this equation can be moved around to solve whatever you need to. For example, if we need to know the ending balance in any account, we can use the appropriate beginning inventory and what gets added and what gets withdrawn from that account to calculate what we need. So we moved ending balance to one side and took everything else to the other side in two easy steps. We will massage the equation we just learned to go through the steps of calculating cost of goods manufactured. In step 1, we are interested in finding out how much direct material got used in the period. So we move our equation around to solve for cost of direct material used. You can do the same step using the T accounts that we have shown you before. In step 2, we combine the cost of direct material used with other manufacturing costs just to have all manufacturing costs in one place. Remember, Step 2 did not use any equation we described earlier. It is just a side step for cost accumulation. Now move to work in process account, where total manufacturing costs are combined with beginning inventory, and cost of goods manufactured is calculated by subtracting beginning inventory out of the total of what we saw on the debit side of the work in process account in the T accounts. Finally, we come to finished goods inventory account, where cost of goods manufactured is added to beginning inventory to get total goods available for sale. If we subtract ending inventory from this total, we will get cost of goods sold, which is the number we are interested in, because this number will go into income statement to calculate company's operating income. So now that we have seen the flow of costs, through T accounts and also through equations, let's try to nail it by looking at it one more time in the form of statements. In the first step, we calculate cost of direct material used using the same logic as before. We add what we started with and what we purchased to get what we have, and then subtract what is still in inventory to figure out what must have been used in production during the period. We use this number to add together all other manufacturing costs, that is direct labor and manufacturing overhead, which will go to our second work in process account, to our second account, which is called work in process account. Here, we carry over the total manufacturing cost to the work in process account, add beginning inventory to it, and get total work in process for the period. Once we subtract ending inventory from here, we can get cost of goods manufactured, which will be taken to finished goods inventory account. Here, we take cost of goods manufactured from work in process account into the finished goods account, just like we did in T accounts, and then we add beginning finished goods inventory to it. Adding together, we get cost of goods available for sale. Once we subtract ending finished goods inventory, we would get cost of goods sold. This cost of goods sold would then be transferred to income statement, as you have been seeing. Let us look at inventory in other companies. Merchandising companies are those companies which do not make anything. They simply collect stuff from all over the place and sell it in their store. Naturally, they are not likely to have any raw material inventory or any work in process inventory on their balance sheet. As a result, they would have only merchandise inventory, which is like the finished goods inventory account. When you need to calculate the cost of goods sold for a merchandising company, you can take their beginning merchandise inventory, which is the same thing as finished goods inventory, add all the purchases they have made, and subtract ending inventory out of it to get the cost of goods sold. Service companies are even easier. They have no manufacturing costs and no purchases, therefore no inventory on their balance sheet. So they calculate cost of sales rather than cost of goods sold. So when their income statement is made, you take revenue minus all the cost that they incur in running their business and calculate their income. This one is easy. The question wants to test if you understood the nature of merchandising companies. Remember, they have no raw material, no work in process, only merchandise inventory. So, the correct answer is A. You are given 4 companies and you are asked to choose which one is a merchandising company. Remember, Ford and Hewlett Packard are manufacturing companies. Accounting firm would be a service company. Macy's is a company that buys merchandise and sells it without changing its basic form. So the correct answer would be C. The question says, which costs are all manufacturing costs that are related to the cost object but cannot be traced to that cost object? And your options are direct material costs, period costs, indirect manufacturing costs, and direct manufacturing costs. Remember, direct manufacturing labor costs are those costs that are related to the cost object and can be easily traced to the cost object. Only indirect manufacturing costs are those that are related to the cost object but cannot be traced to that cost object. So our correct answer in this case is C. Let's look at one more. What are inventoriable costs? Inventoriable costs are those costs which are expensed in the accounting period in which the products are sold. So B is the correct answer. Remember, inventoriable costs are those that follow the inventory, which means they follow the product, which means if the product does not get sold, they stay as inventory. So they would be expensed in the accounting period in which the product will be sold. All other options are wrong. Let's look at a simple numerical problem. You are given the beginning finished goods and ending finished goods. You are also given cost of goods sold. You are given sales revenue, and you are given operating expenses, which are non-manufacturing expenses of 155,000. The question says, what is the cost of goods manufactured? Now think about it. Where do you find cost of goods manufactured? You typically find it in the finished goods account. And notice you are given beginning finished goods, you are given ending finished goods, and you are given cost of goods sold. So you should be able to find the missing amount of cost of goods manufactured once you know the basic equation. Fairly simple. So take 270,000 of cost of goods sold and add ending inventory to it and subtract the beginning inventory of 90,000, and the correct answer would be 257,000 of cost of goods manufactured. Next question, same information, but this time the question wants to know what is the gross margin for the year. Remember, gross margin for the year is sales revenue minus cost of goods sold. You are given both sales revenue and cost of goods sold, so your answer is fairly simple. 500,000 minus 270,000 of cost of goods sold would give you gross margin of 230,000. Are you big? Let's look at one more. Question says, what is the operating income for 2010? Now, you already calculated gross margin before. All you need to do is to subtract operating expenses from your gross margin to be able to get operating income for the next year. Are you getting it? This one says, for a manufacturing company, direct labor costs may be included in direct materials inventory only, merchandise inventory only, both work in process inventory and finished goods inventory. Finally, it says indirect material, work in process and finished goods inventory. Remember, we are talking about direct labor. So direct labor cannot be in direct materials inventory. However, it can be in work in process inventory and also in finished goods inventory. How does it reach finished goods inventory? Since it is easy to see how it reaches work in process. Remember, if goods are not if the goods are not sold, then a portion of their labor cost is sitting in the finished goods inventory account. Therefore, the correct answer is C. Let's look at a last one. You are given beginning and ending work in process inventory and beginning and ending finished goods inventory, and you are given cost of goods manufactured, and the question wants to know what is cost of goods sold. All you need to do here is to pick the right account. Remember, cost of goods sold is found in finished goods inventory. So you would take beginning finished goods inventory, ending finished goods inventory, and cost of goods manufactured to come up with the cost of goods sold number. You can use a T account if you are comfortable with it, or you can use an equation as I have used Or if you want, you can even make a statement, but the correct answer would still be the same. Prime cost is a term used for all direct costs, direct material and direct labor. Conversion cost is the cost of production, the cost incurred in converting raw material into a finished product. The distinction is useful in those companies where most factory work is automated and therefore there is hardly any direct labor cost. Thus, they combine direct material and tiny little direct labor and call it prime cost. In those companies where manufacturing overhead is a big portion of total cost and direct labor is typically combined with manufacturing overhead, and it is called conversion cost. There are two controversial issues in labor. Overtime premium is wages paid to workers over their regular wages or salary or wages or salaries. Since overtime is a tiny amount of total labor bill and is likely to change each period, it is better to treat it as indirect labor cost rather than direct labor cost. Idle time, similarly, are wages paid to workers for unproductive time due to company's fault. For example, if workers come to work but there is no power or there is no raw material, or if a machine is broken down and no work is getting done, workers will still have to be paid. These idle time wages are also likely to be a small amount and are not part of the company's routine labor costs. So they are better off in the indirect labor category rather than as direct labor. The companies like to keep their direct material and direct labor numbers as clean and as consistent from one period to another as possible and do not want any volatile numbers to enter in there. Let's end with a quick question on labor. Out of the total 45 hours, 5 hours are overtime and 3 hours are idle time, both belonging in manufacturing overhead account. So let's keep them separate. For the other 37 hours, we will be paid $20 an hour. That would be $740 of direct labor, plus some amount of indirect labor, which we have not yet calculated. So look at the indirect